Hey everyone, welcome back to Corporate Decoder. Today, DWS Latin America Equity Fund just filed its semi-annual shareholder report for the 30th of April 2026, and I'm seeing a lot of consistent strategy at play. Quick note, this is not financial advice, just my take on public filings for educational purposes. The fund is heavily invested in Latin American companies, and their major holdings are very concentrated, which means big swings are possible. This report covers the first half of 2026, and it gives us a snapshot of where the fund is putting its money and how it performed. Let's start with costs, because that is what directly impacts your returns. For a hypothetical $10,000 investment, Class A investors saw costs of $77, which is 1.39%. Class C investors paid more, $118 or 2.14%, and Class S and institutional class investors had the lowest costs at $63, or 1.14%. This difference mainly comes down to sales charges and ongoing fees, so it is important to know which class you are in. The prospectus mentions these costs could have been higher without certain waivers, which is good to keep in mind. Now let's look at the overall health and activity of the fund. The total net assets are a substantial $408 million. The fund holds 70 different investments, but that is not a lot when you consider the size. The portfolio turnover rate is 59%, which means they are buying and selling investments fairly often, probably to react to market changes. And the total net advisory fees paid out were over $1.6 million, which is significant. Diving into what the fund actually invests in, it is heavily weighted towards stocks. A massive 92% of the net assets are in equity securities, only 1% is in exchange, traded funds, and 7% is in cash or other assets. This high concentration in equities means the fund's performance will closely follow the stock market, especially in the regions it targets. Looking at the sectors, financials make up the largest slice at 23%. Materials are next at 18%, followed by utilities at 13% and energy at 12%, industrials. Real estate, consumer discretionary, and consumer staples each take smaller portions. Healthcare and communication services are minor holdings. And information technology is at 0%. This sector mix shows a strong focus on core economic activities in Latin America, rather than growth-oriented tech companies. This is where things get really interesting. The fund is heavily concentrated in just a couple of countries. Brazil dominates with 62% of net assets. Mexico comes in second with 23%. Peru has 4%, Chile has 2%, and Uruguay and Argentina have just 1% each. Notably, there is 0% invested in the United States. This extreme concentration in Brazil and Mexico means the fund's performance will be heavily influenced by the economic and political situations in those two countries. And when we look at the top holdings, it reinforces that concentration. Petróleo Brasileiro SA Petrobras from Brazil is the biggest at 10%. Vale SA, also from Brazil, is next at 5.8%. Grupo Mexico SAB-de-CV is the largest Mexican holding at 5.2%. Banco Bradesco SA from Brazil is at 5%. Axia Energia SA from Brazil is 4.4%. New Holdings Limited from Brazil is 3.6%. Grupo Financiero Banorte SAB-de-CV from Mexico is 3.4%. CIA de Saneamento Básico do Estado de São Paulo SABIS from Brazil is 3.2%. Equatorial SA from Brazil is also 3.2%. And Cemex SAB-de-CV from Mexico rounds out the top 10 at 3% together. These top 10 holdings represent a huge 46.8% of the fund's total net assets. This means the performance of just these few companies has a massive impact on the entire fund's returns. It is a high-risk strategy but could offer big rewards if these companies do well. Now let's dig into the actual investment portfolio as of the 30th of April 2026. We see many of the names we just discussed. For instance, in Brazil, they hold various classes of shares for companies like Axia Energia SA Banco Bradesco SA and Petróleo Brasileiro SA Petrobras. They also have significant positions in Vale SA and New Holdings Limited. The total cost for all equity securities was over $271 million, and they were valued at over $374 million. That is a good gain here. In Mexico, holdings include Cemex SAB-de-CV, Grupo Mexico SAB-de-CV, and Fomento Económico Mexicano SAB-de-CV. The total cost for Mexican equities was around $67 million, valued at over $94 million. Also showing a profit, there is also a small position in Chile, mainly Banco de Chile, and a small position in Colombia. Interestingly, there is a small holding in the United States, Aura Minerals. They also have an investment in an exchange-traded fund, the iShares MSI Chile ETF, worth about $3.9 million. And finally, there is Securities lending collateral, which is essentially cash held by the fund as security for loans of its own securities. This is valued at over $4.6 million. Looking at the statement of assets and liabilities as of the 30th of April 2026, the total assets are over $418 million. Investments in non-affiliated securities alone are valued at over $378 million. Cash reserves are also healthy at over $18 million. On the liability side, total liabilities are around $10 million. This leaves net assets at $408 million, matching our earlier figure. Now, the statement of operations tells us about the fund's income and expenses for the first half of 2026. Total income from dividends and securities lending was over $8.6 million. Total expenses after reductions were just over $2 million. This resulted in a net investment income of over $6.5 million. But the real story here is the net realized gain of over $29 million and the change in net unrealized appreciation of over $35 million. Combined, the net gain from operations was over $71 million for the 6-month period. That is a very strong performance, driven by investment gains rather than just income. These statements show how the net assets changed over time. For the 6 months ending the 30th of April 2026, the net increase in assets from operations was over $71 million. However, distributions to shareholders reduced net assets by over $12 million, fund share transactions. Meaning money coming in from new investors and going out to those redeeming shares actually increased net assets by almost $45 million. Overall, net assets increased by over $103 million in just 6 months, from about $304 million to $408 million. That is substantial growth. The financial highlight section gives us a per-share breakdown of performance and key ratios over several years. For Class A shares, the net asset value at the end of the period was $41.7. The total return for the 6 months was a very strong 23.24%. Looking at historical performance, Class A had a 30.08% total return in 2025 and a negative return in 24. The ratio of expenses after reductions for Class A is 1.39%, which is pretty standard for this type of fund. The portfolio turnover rate for Class A is 59% for the 6-month period, as we saw earlier. The notes to financial statements provide crucial details. This fund is a non-diversified series of DWS International Fund. Inc. It offers different share classes, Class A, C, S, and institutional, each with different costs and features. The fund's investments are valued using a Level 1 fair value measurement, meaning they rely on quoted prices in active markets for identical securities. This suggests most of their holdings are liquid and actively traded. They also discuss securities lending, where the fund lends out its securities to earn extra income. As of the 30th of April 2026, they had securities worth over $4.6 million on loan. There is also a note about tax information, including capital loss carryforwards, and importantly, they discuss the advisory agreement board considerations and fee evaluation. This section details how the board of directors reviewed and approved the investment management agreement with DWS Investment Management Americas, Inc., or DEMA, and the sub-advisory agreement with ETA USA Asset Management, Inc., or IWAM. The board, made up of independent directors, spent significant time reviewing the fund's performance, fees, expenses, and DIMA's profitability. They compared the fund's performance to market indexes and a peer group provided by Morningstar. For Class A shares, performance was in the 4th quartile for 1 and 3 year periods, but in the 1st quartile for the 5-year period. They also looked at fees, noting that the contractual management fees were higher than the median for similar funds. However, they also noted that expense limitations were in place to keep overall costs competitive. The board considered DEMA's profitability, concluding that it was not unreasonable. They also noted that DEMA pays the sub advisory fee to IM out of its own management fee. Economies of scale were considered, and the fee breakpoints in the schedule were seen as an appropriate sharing of benefits. Finally, they reviewed other incidental benefits to DEMA and OIM, like administrative and transfer agency fees, and concluded that the management fees were reasonable. The company's chief executive and financial officers have stated that their internal controls and procedures are effective. There have been no material changes in their internal financial reporting controls during this reporting period. The filing includes certifications from the principal executive and financial officers confirming compliance with CC rules. The report is signed by Hepson Uskan, the principal executive officer, and Diane Kennelly, the principal financial officer, on the 29th of June 2026. Now, looking at this fund's strategy, the heavy concentration in just a few Latin American countries, particularly Brazil and Mexico, presents a significant risk. Small economic or political shifts in these regions could have a large impact on the fund's performance. The strong gains reported in this period suggest the fund's investments performed very well, but this concentrated approach also means potential for sharp downturns. The fact that they are actively managing this concentration by reviewing its effectiveness and comparing it to peers shows that the board is aware of the risks involved. A key takeaway here is that while the fund has a strong performance for this reporting period, its future hinges heavily on the economic stability and growth of Brazil and Mexico. That is my take. Stay decoded. If you want the broker and charting tools I use, they are linked in the description. Like, comment, subscribe to see more.